Welcome to the InvestSense market commentary for the third week of January 2026, and a pretty short one as it's only been a few days since we spoke last and not an awful lot's happened. There's been some decent economic data out of the Europe and US jobs numbers, not too bad either. Probably what's been dominating headlines is more of a geopolitical nature, more about that later, but it hasn't really moved markets. And one of the interesting things about this graph is something that we've seen for quite a while actually is a little bit of volatility in NASDAQ and de facto S&P 500. It's the largest US companies that are the most volatile because of those high expectations. And as we go into US earnings season, we'll be talking more about that. But so far, the first few reports that we've seen, mainly from the banks, have been sort of mixed but okay. There's also been some consumer and airline stocks that have actually reported quite well. Overall, only 7% though. It's just a smattering. And companies generally report above expectations, but it's about sort of 5 or 6% compared to 7 or 8%, which it is usually. So nothing really to see here so far. One of the things that people do talk about, though, or that we get questions from, is about the impact of geopolitics. And obviously that's been in the news and it hasn't moved markets. If we look at this chart here, we can see it's been basically pretty positive. The rotation trade is in play, as we said. Very little volatility from things like emerging markets, small caps, etc. But the real standout last week, but this year so far as a whole, has been the Russell 2000. And when you look inside there, it's basically the industrials. There's a bit of a Make America Great Again flavour to this, as well as information technology, but transport stocks and energy as well. All the biggest contributors, some of those sort of subsectors up by about 20% so far. So there's definitely some positive momentum there. It might also be a technical thing because the Russell 2000 has become a bit of a trading mechanism for the MAGA trade. So, it could be a bit of tail wagging the dog. Who knows? But yeah, back to that geopolitical question. This is a chart or variants of it, which people always find quite kind of interesting. And one of the sort of accepted things is that if it's just sort of noise, and especially in this day and age when, market is probably getting relatively inured to some of the announcements that come out from the White House. But it's always been a truism, actually, that geopolitics is very difficult, especially when there's binary outcomes for markets to discount. So they generally don't do a lot. But the other interesting part about this is even when there is something which should be market moving, now we've got right back to World War I, World War II, Korean War, and then through to sort of more recent events like the Ukraine war. You will often see a bit of a move from markets, but it's, we're talking like 5, 10, sometimes 15%, for instance, around 9/11. But the interesting thing is the green bars, 12 months on, which is what that shows. So the red bars are the initial drawdown, and the green bars are what happened in each situation 12 months on. And actually, on average, markets do quite well. So if you look at that very right-hand side, you've got a drawdown of just under 10%. And when you put all those events together, there's about 15 or 20 of them there, rate spanning over, a good 100 years. Markets up 14% 12 months later, and that includes 2 world wars. Maybe the rationale there is that there's a sort of sell the news, but then later on there's a bit of a relief rally. Certainly, probably not something you'd want to rely on, but it does counter the narrative that geopolitics is a particularly bad thing, unless there's a direct economic impact, which is something that we saw in the Yom Kippur War, which led to shortages of oil. So, not something that you definitely trade on, but not something that you trade against is maybe what we're saying there. And maybe that just gives some comfort that a lot of these big geopolitical headlines not always market moving. So thinking forward to the earnings season, may be useful to think back 6 months. And there has been this notion of a rotation trade coming back to the fore. And when you look at the top 15 stocks, which is what we've got here, it's actually a little bit all over the place. But one of the surprising things is Google. So that'll be one of the more widely awaited results and guidance, up 70%. So remember, very much out of favor, was seen to be sort of missing the AI bandwagon, but they've turned that boat around and seem to be one of the biggest beneficiaries. Their search business perhaps not going to suffer as much, and Gemini doing very well, and a sense that they're actually going to be able to leverage this and evolve into the AI assisted search era, and be able to monetize that better than, for instance, Microsoft, which is down 10% for 6 months, albeit on quite high valuations. Netflix down there 30%, Tesla sort of somewhere in the middle there, but quite volatile. And then you've got a smattering of those more industrial stocks, ExxonMobil up sort of more recently, Broadcom all over the place. So really, as we go into earnings season, it is going to be the results that matter. Google was seen as sort of one of the more resilient, cheaper ones. Not so anymore, and everything just looking a little bit vulnerable, and we'll be watching that with eagle eyes, and maybe we'll have a little bit more to talk about next week. In the meantime, tune into our video this week with Christian Bayliss of Fort Lake, where we talk about the bond markets, duration, the relative merits of that, some of how this uncertainty may be being discounted by the bond market or not, because actually not a lot happening there. He also talks about the fact that credit spreads are very tight, so it's kind of difficult to know where to go. His strategy is go anywhere, and he is finding some interesting opportunities in the default space. But he also says that without a clear economic catalyst, high quality investment grade doesn't really look like there's anything to be too worried about there at the moment. But again, something he's watching very carefully, and some interesting comments on bond markets as a whole, as this is a manager that can really play anywhere, and it's kind of interesting where he ends up. We think it's an interesting conversation because of his background with a PhD in inflation forecasting and a bond strategist, but also with a very specific focus now, which is of interest to a lot of people thinking about credit defaults and what it means for private credit, etc. So an interesting conversation there. Hope you enjoy it, and look forward to talking next week. Thank you. Bye.